David Rodriguez at Quantum Strategy joins us right now, as well as Seth Freeman, Senior Managing Director, Glassstratner Advisory and Capital Group. Thank you so much, gentlemen, for taking time out this morning. And it is, a very interesting setup that you have right now. You do have West Asia on a knife's edge. You do have a barrage of headlines that you're looking at right now. But against that backdrop, Seth, I'm going to come to you first because the risk of trade is very clearly, it seems to be gaining momentum right now. What's your first take when it comes to this particular conflict?
Well, I think it's definitely going to be risk off, and we're only seeing the beginning impacts in the marketplace and the impact in the broader impact of higher oil prices and supply constraints. We have yet to see that, given that 99%, I think, of Iranian oil had been going to China.
No, absolutely. And David, I also wanted to take this across to you. When you talk about oil, having no oil to export, that would also motivate the Iranian, the country to, disrupt oil supply. When you talk about the rest of the world, how are you looking at that particular development? Because right now, it is not business as usual at all. It is not the main supply-demand fundamentals that you would typically be looking at. You're looking at a full-blown war right now.
Well, I think that's the key point. You just made it. The Iranian strategy has changed from previous wars. They're now in the business of causing maximum damage to everybody else and maximum damage to world oil supply. So it's really a totally escalated endgame, which is different. So here's my take. It looks to me like from the satellite photography, though this has not been confirmed by the military sources to me anyway as yet, that the Cork Island facility for exporting oil has been pretty well wiped off the map. If that is the case, then you're going to lose approximately between 1.6 and 1.8 million barrels a day of oil exports, principally to China. But if China is not getting them, then China has to buy them someplace else. So basically that comes off world supply. That's about 1.82% of world supply of oil. If you put that into your little models, which deal with history, and history may not be a reliable guide, given that the oil price is the oil supply is extremely inelastic to changes in the oil price, that sort of drop in the oil supply would dictate an increase in oil prices of someplace between 10 and 20%. So to put that in perspective for the average punter, that would mean that Brent oil would be selling at $85 to $90 rather than $72, $75, which it is today. So I concur with my fellow wise person on the program today that I think you haven't seen anything yet. You've just seen the risk-off gut reaction. What you have not seen is a reflection of the fundamentals, which a more prolonged and more damaging war would cause through the channel of the transmission of oil prices.
Absolutely. And, we're just at the beginning of this. It does look like it's going to be a very long, drawn-out conflict right now. There are no signs of it easing, and the commentary on both sides is very clear on that as well in terms of the timeline, that it's going to take a while until this very much subsides. But with that in mind, Seth, I'm going to come to you because historically, if you play the devil's advocate, the markets do shift their attention when you talk about a situation like this. So be it Russia, Ukraine that you're talking about, if you're talking about US, Libya as well, you've seen that there's a reaction, yes, and after that, just before and just after, you do have markets reacting. And then after that, it seems to subside just a tad bit. But that being said, there's a series of global shocks that you're looking at, lots of geopolitical triggers. How are you then balancing it out when it comes to the markets?
To the extent that investors weren't covered, they're going to see some losses in the next couple of weeks. One of the problems is we have yet to hear from the president of actually what the absolute objectives are of this activity. And it can go, as he said at the beginning, well, it could be 3 days, it could be weeks and weeks. He really has to tell Congress and tell the American people and the world what the final outcome objective is. If it is a total regime change, well, that's going to take longer. There's going to be tremendous resistance to U.S. Boots on the ground, for example. And this is going to this uncertainty is going to continue to influence the markets. Now, oil is just so central, and depending on how long this takes, we could see prices rise in sectors that affect U.S. consumers, especially in agriculture and other imported items. So I think this could have a very broad impact.
Absolutely, a broad impact is definitely something that you're penciling in right now, David. I'm going to come across to you also because, you know, it's very important to take a note of the geopolitical risk premium that you're looking at, both in the near term, but also going forward as well. Because, you know, when you talk about this particular oil export capacity, when you talk about Iran, you could be facing a multi-year outage if, you know, you see those reports of destruction to be true. You're looking at a big scale of damage here right now.
Well, you know, that's dead right. I mean, my oil price at 85 is really based upon that structural damage continuing for, say, 18, 24 months. So that is the economically rational price at which oil would settle if my understanding of the damage already done to Iran oil facilities is true. But of course, what you have pointed out is that is not how the real world works. And Seth has said it too. What the real world does is to react to this stuff. Holy God, they say, you know, I've been short. I've been really short oil. I thought there was plenty of oil around, blah, 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 blah. And all these people have to come into the market and cover those positions. So that's the first thing. So you get a spike and then a return to a rational level. The point I'm making is the rational level is 85. The current level is, say, 75. So there's a huge difference. The second thing I would say is making that remark, taking what you said, the spike and then the settling down to a more rational level, that applies to all the assets to a degree. The risk premium for equities has gone up. The inflation rate has gone up because of oil prices. And of course, the growth rate has gone down. So everything has to adjust according to this. Even sovereign bonds suffer from the higher yields. They'll also suffer from higher defense expenditure if this war drags on. So what I'm saying is we need to split this in two parts. Initial reaction, which is set by people covering or adjusting their portfolios in a hurry. And then you get down to where the economic fundamentals dictate you should be. And the argument I'm making, and I think Seth is making it too, is that first you get the gut reaction, the immediate reaction for putting your portfolio in order. And then you get prices settling down to where they should be. But those prices for everything except oil, for all the other assets, are lower than where they are today. And for oil, they are higher than where they are today. So again, this may be a longer drawn out war, but it's also a longer drawn out portfolio effect.
No, absolutely. And Seth, I will take exactly that point across to you. When you talk about this long drawn conflict, are you looking at it in those exactly two parts, as David also pointed out that you are? I wanted to get a clearer sense of what you think about the long-term implication of this.
You know, we were just beginning to feel some relief over the tariffs and the Supreme Court's action. And then the president applied this 10 and possibly 15% blanket tariffs. That, and we had so much uncertainty about tariffs, and now we add on this war. I agree completely about this notion of achieving sort of the rational price, but I am very concerned about sentiment, and I think that negative sentiment can unfortunately prevent us from achieving the rational price if investors remain nervous. And then we've got these other kind of geopolitical issues that we already had before Friday night.
Absolutely. And thank you so much, gentlemen, for taking time out and joining us this morning.